Hi guys, Mark Franke here. This is chapter 24. I'm going to cover the concepts in chapter 24. I'm going to use some of the B problems for illustration. This chapter is very similar to the last chapter 23. It's a decision-making model, but here we're talking about longer-term projects that might go out 10 years, 20 years, even longer. And so in this case, we have to take into account the time value of money. So I'm going to start with problem 24-2b and use that for to describe the first three, which is the cash payback period, the accounting rate of return, and the net present value. This company is the Aikman Company, and we'll call this the analysis of alternative projects, where we have two projects, Project A and Project B. And the first thing that we have to do is figure out what the cash flow is and the income that's going to be generated by these two projects. These models or these problems in chapter 24 are cash flow models. And what that means is we look at the future cash flows. We have to spend money now to buy the equipment or to do whatever it is we're doing, build the building, buy the land, and then we're going to get cash returned to us over a number of years. So these two projects are going to generate sales. For Project A, it's $250,000. Project B, it's $200,000. Now, we also have materials, labor, and overhead for these projects. So we'll go direct materials, direct labor, factory overhead. For these two projects is $35,000 for materials, $50,000 for direct labor, and $30,000 for factory overhead. And we should say factory overhead before depreciation. Because we will have to factor that in. And for Project B, it's $25,000 in materials, $30,000 in labor, and $10,000 in factory overhead before depreciation. We'll total these up, $115,000 in for A, and so we'll say materials, labor, and overhead. And I'll just tie it in here as one of our costs associated with these two projects. Then we'll have depreciation, and we'll do a schedule of that from down below. So let's do the depreciation calculation. The cost of both projects is $240,000. There is no salvage value, but I'm going to put salvage value in as 0 just so the reader knows that I did consider it. So the total depreciation is $240 because there's no salvage value. This is there's two different useful life. There's 3 years for, 4 years for Project A and 3 years for Project B. So the annual depreciation for A is 60,000 and for B is 80,000. And I'll tie that in up above here. Okay, and then we have some selling and administrative expenses, which are going to be the same. $18,000 for both projects. So our operating income or pre-tax income $57,000 for project A, $37,000 for project B. We have the tax expense, which is 30% tax rate. $17 and $11,100. So our net income $39,900 for project A, $25,900 for project B. Now, if we add back depreciation, because depreciation is a non-tax expense, in other words, we don't have to spend money excuse me, for depreciation. We're just making a journal entry. So that's going to provide our net cash flow. So if we're trying to go from net income to net cash flow, we would add back any non-cash expense, and in this case, depreciation is our only non-cash expense. So now we can do our calculations. So our first calculation is going to be the cash payback, where we're going to compare the original cost, and for both these projects, it's the exact same amount. It's the $240,000. Divide that by the annual cash flow, which is the $99,900 for project A and the $105,000 for project B. So the cash payback in years is the cost divided by the annual cash flow, and naturally project B has a faster payback because it's getting more money every year, but it is only a 3-year project. So the nod goes to project B. We're comparing these two to see which is better. The accounting rate of return. Our annual net income, which is $39,900 for project A and $25,900 for project B. The average investment. The average investment is going to be the cost plus the salvage value divided by 2. So in both cases, there's no salvage value. So let's just call this A and B. And this formula is going to be equals A plus B divided by 2. Except it's in the wrong place, so let's move it. Okay, so if we take the cost plus the salvage value and divide it by 2, it's 120,000, and it's the same for both projects. So our accounting rate of return is going to be the net income divided by the average investment, which is 33% for project A and 21.6% for project B. So in this case, project A is better. So now we can do our third measurement, which is going to be the net present value which takes into account the time value of money. Annual cash flows. Again, 99.9. And 105.9 for project B. The present value factor at 8%. This is an annuity. This is the present value factor of an annuity, because these are annual cash flows we're going to get every single year for 4 years for project A and 3 years for project B. If you look up the factor, 3.3121 for 4 years at 8%, 2.5771 for 3 years for project B, the total present value if we multiply it out and then subtract the original cost, that will give us the net present value. And if I use my drag tool, and in this case, project A has a much higher net present value. So in this case, 2 of the 3 measurements favor project A. We would adopt project A as being the better project. So let's look at a situation where we have other cash flows that we can schedule out. This is problem 24.4b, and this is Archer Foods. And what I'm going to do here, this is a schedule of net present value for repairing the freezer. This is a situation where we can either repair the freezer or we can buy a new one. So we'll do the first repairing the freezer one first, and then we'll just copy it and we'll change the information for if we buy the freezer. How to do that using Excel. It's very, very simple. Okay, so year 1 to 8, we are going to have revenue, which is positive cash flow, of $63,000. The factor for an annuity, this is for 8 years, is 5.3349. So the present value of those positive cash flows is $336,099. Also, year 1 to 8, we're going to have negative cash flows for expenses. And that's 55,000. Same factor, but this time it's negative cash flows, 293,420. And then in year 8, we're going to be able to get $1,400 for the salvage value. And we'll label that salvage value. So what that means is the total present value is the sum of these 3 components, or $44,079. The cost of the repair is $50,000, not $5,000. So we have a negative net present value, which means that this project, repairing the freezer, doesn't have an internal rate of return that's higher than 10%. That's what that negative 5,921 means. And we can prove that by scheduling out these cash flows. So we're going to have 50,000 in the first year, negative when we buy or when we repair the equipment. Then we're going to have $8,000 every year for 8 years after that. That's the cash flow. So if I use the IRR tool, which is under financial, this is one of the functions, IRR, I've scheduled out the cash flows. So I'll just put that in, and that gives us an internal rate of return on this project of 5.84%. So we've done the net present value on the left side, and we've done the internal rate of return on the right side. Now, the internal rate of return is very easy when you use Excel. It's impossible to calculate it unless you have an internal rate of return function in your calculator, which if you have a financial calculator, most of them do have that. But I did this just to illustrate how this works. Now, I'm going to just copy this whole section and paste it down below, and then modify it for buying a new freezer. So instead of repairing, we're going to be buying a new freezer. Okay, freezer. And the cash flow is $68,000 in revenue every year, and the expenses is $30,000, and our salvage value is $3,732, which means our total net present value is $206,458, but this new freezer is going to cost us $145,000. So our net present value is $61,458, and if I plug in the cost of repair of 145,000, our internal rate of return on this project is 20%. So you can see from the net present value that it's way over 10%, but if we calculate the actual internal rate of return, it's 20.19%. So looking at both of these spreadsheets, and I'm going to move this, that's okay. We can see that buying a new freezer makes the most sense. So I'm just going to add a little text box, and I'm going to say based on this analysis, we should buy a new freezer. Or something like that. Just to tell whoever we're doing this analysis for that this is the better decision, the better project. Okay, for 24.6b, this is going to introduce the concept of break-even time. Break-even time. What I'm going to do is I'm going to pause the video and I will put in the information and then I'll be back. Okay, so I've put in the cash flows that they've given us in the book, and then I've also put in the present value factor at 10%. This is just individually because I've done these cash flows for each year separately because the cash flows are not the same every year. So we've got to do this now each year separately. So the cumulative cash flow is just a running total. So the first year we have to spend $800,000, and then we get $450,000 back in the second year. And by the end of the second year, we have positive cash flow, and we end up with total positive cash flow of $700,000. But you can see that the cash payback is somewhere towards the end of year 2. So I'm just going to guesstimate the cash payback as 1.9 years. So at the end of the second year, we have $50,000 positive cash flow. So it means that we became positive somewhere towards the end of the second year. So I'm using 1.9. Now, if we multiply the cash flow each year times the factor, the cash flow times the factor, the original cash flow, what this is going to do is tell us what the net present value is. Virtually it's the same way we calculated in the other problems. Just kind of formatted it a little differently. 407,510, that means that the internal rate of return must be way more than 10% because we have a very big net present value. So I'm going to calculate the internal rate of return by just taking the cash flows and using that IRR function. I'm using the cash flows from the cash flow column and convert it to a percent, and it is 33.8%, and I'll just put a little box around that. But that's the actual internal rate of return. So you can see it's way more than 10%. Now, if I calculate the cumulative present value, I'm going to do the same thing I did with the actual cash flows, but now I'm doing it with the present value cash flows, and you can see what happens is our payback gets stretched out a little bit, and this is called the break-even time. The break-even time is the cash payback using present value amounts. So if we take at the end of year 2, rather than being 50,000 positive like it was with just the raw cash flow, it's actually a negative 60,345. So I'm going to guesstimate that to be the break-even time of 2.2, because we become positive in the start of the 3rd year. If you take the 60,000 divided by this 262,000, you're going to get about 20% or 2. It's close enough. So the break-even time in this case is 2.2. That's enough for chapter 24. That gives you something to practice, that you have the numbers. I'll see you again next time. Bye-bye.